Good morning. My name is Joanna, and I will be your conference operator today. At this time, I would like to welcome everyone to the Canadian Zinc announces feasibility study results for Prairie Creek Mine conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, please press star, then the number 2. Thank you. Mr. John Carney, Chairman and CEO, you may begin your conference.
Thank you. Good morning, everybody, and welcome to this conference call by Canadian Zinc Corporation. We thought that following our news release of the 28th of September, which on the results of our feasibility study, which contained a lot of numbers and a lot of information, that we should host a conference call with the objective of trying to explain, if necessary, any of the information in the news release and provide an opportunity for investors and analysts to ask any questions. I'm joined this morning by our Chief Operating Officer, Alan Taylor, and our Chief Financial Officer, Trevor Cunningham, as well as Steve Dawson, VP of Corporate Affairs. Before beginning, I'm on slide 2, a cautionary statement. As you can imagine, the summary results of the 2017 feasibility study, which we reported in the news release of September 28th and we're discussing in this presentation, are preliminary. The full details of the results and further information on the key assumptions, parameters and risks associated with the feasibility study will be included in the technical report, which will be filed on CEDAR within 45 days from the date of the news release. The presentation and the news release also contains forward-looking statements. These statements about the company's planned proposed Prairie Creek mine operations, future grades, recoveries, future cost estimates, outlook for the future prices of zinc and lead are not guarantees of future performance and are subject to risks, uncertainties, etc. Therefore, the company's actual results could differ materially and adversely from those expressed in any forward-looking statements. The company cautions that these lists of factors are not exhaustive, and investors should consider those risks in addition to the other information in the company's filings and various public disclosures before making any business or investment decisions involving the company or its shares. On slide 3, the highlights. Suffice to say that we were very pleased with the results of the feasibility study. We see it as a major milestone for the development of the Prairie Creek mine, and the study confirms strong project economics, which we believe will provide significant potential value for the shareholders. The results show many improvements from the 2016 pre-feasibility study, and we believe demonstrate the potential of this world-class asset. We believe it's a world-class asset, and confirm that the development of the Prairie Creek mine will provide material benefits to the local communities and to the economy of the Northwest Territories for many years. The main improvements, significant improvements from the 2016 PFS, as set out on slide 3, increased mining rate, increased mill throughput, higher zinc, lead and silver production, lower operating costs, increased net revenue, higher NPV and IRR, and moderately higher CapEx. I'm going to go through each of these more or less sequentially. So turning to slide number 4, which is the outline or the summary of the mineral reserves. The total mineral reserves are shown as 8,771,463 at a grade of 124 grams of silver, 8% lead, and 8.64% zinc. So that's a small increase in the mineral reserve. Tonnage has increased from the PFS. The grade of lead is up, the grade of zinc and silver is slightly down. The tonnage in the 2016 PFS was 7.6 million tons, and that's been increased to 8.1 million tons, largely as a result of a change in the zinc equivalent cutoff as a result of lower operating costs. Essentially the same numbers been confirmed, slightly higher tonnage, higher lead grade, slightly lower zinc grade, slightly lower silver grade. On slide number 5, on the mine side, The mining rate is increased by 18.5% by 250 tons per day to 1,600 tons per day. As part of the study over the last 9 months, a number of optimization programs that had been recommended in the PFS had been completed, and these have had a beneficial impact on the project. And they demonstrate the capacity of the mine can be increased from 1,350 tons per day to 1,600 tons per day. It will result in the average annual mining rate moving from 485,000 tons to 584,000 tons per year. That will require more increased lateral mine development, pre-production mine development, which increases from 49,000 meters to 52,000 meters. One of the impacts of that increased mining rate is that it does shorten the mine life very, very slightly by just under 2 years. On the back end, it reduces it from 17 years to just about 15 years. But it does significantly improve the production in the first 10 years. Also, an important benefit that's achieved, we've been able to, from the optimization, we've been able to mine a higher ratio of sulfide ore compared to oxide ore in the earlier years, and of course we get better value, better revenue from the sulfide ore. So the principal purpose, if you like, of the increased mine production is to feed more tonnage to the mill. And on slide number 6, we're showing a very important and significant improvement in the milling rate by 25%. That has been made possible by the installation of new grinding and flotation circuits, a somewhat a simple, more efficient flow sheet, and a new reagent scheme. The net result is that the capacity of the mill is increased from 900 tons per day to 1,200 tons per day, and enables us to produce more metal at a faster rate than projected in the 2016 PFS. We're forecasting that in the first 10 years of operation, the mine will produce 72,000 tons of lead concentrate per year and 65,000 tons of zinc concentrate. That concentrate will total contain metal of 95 million pounds of zinc, 105 million pounds of lead, and 2.1 million ounces of silver. There are yearly averages and a significant increase from the pre-feasibility study, specifically in the first 10 years. And we focused on the first 10 years where obviously that's the most important point. As I should have said back when I was talking about the reserves, that in addition to the 8 million tons of mineable reserves, the company also has, Prairie Creek also contains a very significant inferred tonnage of mineral resource. It's about 7 million tons at similar grades. And we're very confident that with ongoing mine development and ongoing infill drilling, that a substantial proportion of those inferred resources will be converted into proven and probable reserves, and thus will increase or lengthen the mine life beyond what we're currently indicating is 15 years or 14 and a half years. So the production of lead is up substantially. The production of zinc is up a little bit, and the production of silver is up also. So increased production from all three metals. So moving to slide number 7 on the transportation side, as we announced in our press release a couple of weeks ago, we were pleased to advise that the Mackenzie Valley Environmental Impact Review Board have recommended approval of the environmental assessment of the all-season road. This follows almost a 4-year environmental assessment process, and the review board came out with a positive recommendation and has recommended that the all-season road be approved. This is an important development for the company because it enables us to operate the road on an all-year-round basis or an all-season basis. That will enable timely delivery of concentrate, exporting the concentrate to market on a consistent basis, and also will enable consistent and timely delivery of inbound fuel and inventory materials. The all-season road, of course, also lowers the logistical risks. It enables us to operate throughout the year and not just in the winter months, which of course have shorter days. It also results in a smaller trucking fleet. We don't need as many trucks as you would in just on the winter road. And finally, importantly, it allows us to consider alternative energy sources, specifically lower cost LNG, which has a lower cost and also lower environmental impact. The transportation plan involves the concentrates being trucked from the mine to Fort Nelson. A slight change from the pre-feasibility study. We're now proposing to use 20-ton containers, that the concentrate will be inside the containers, and the containers will be moved from the trucks to the rail without the needing for a stockpile at the railhead. At Fort Nelson, the containers will be loaded onto the train, and from there they'll be transported by rail to Vancouver for onward shipment to the smelters. And moving to slide number 8, the feasibility study has used the marketing arrangements that we have previously announced with MOUs signed with Korea Zinc and Boliden. Each of these have agreed to take our concentrate. Korea Zinc in the MOU have agreed to take between 20 and 30,000 tons of zinc sulfide and 15 to 20,000 tons of lead sulfide plus 5,000 tons of lead oxide per year, while Boliden has agreed to take 20 to 40,000 tons of zinc sulfide concentrates. And as you can see, that almost accounts for 100% of our zinc production for the first 5 years of the mine life. The treatment charges are under the MOUs. Treatment charges are to be set at annual benchmark, as agreed by the major suppliers, major smelters, and the major miners, with payables and penalties to be negotiated annually, including agreed limits for mercury levels in the zinc concentrate based on the indicative terms. In the feasibility study, the treatment charges that were used in the 2017 feasibility study, we used $172 per ton of zinc concentrate and $130 per ton of lead concentrate. Both of those treatment charges are significantly higher than current spot charges, but we decided that we should take a more conservative long-term view and not to assume that the current spot price can continue. The current spot price for lead, spot treatment charge for lead is much lower, and so also the one for zinc is significantly lower. In any event, we took a conservative approach here and used 172 for zinc and 130 for lead. On slide number 9, the major differences or key variances between the 2017 feasibility study and the 2016 pre-feasibility study are outlined there. The optimization led to improvements with only a modest increase in capital costs. As I said, the mining rate is up 18.5% to 1,600 tons per day. The mill throughput after DMS processing is up 25% to 1,200 tons per day. A lower operating cost, down 2.6% to $223 total per ton mined. That includes transport. And the mineral reserve tonnage is up 6% to 8.1 million tons. On the financial side, there are significant improvements on the financial side. The net revenue for life of mine is up by $325 million to almost $3 billion. The undiscounted pre-tax cash flow is up to $900 million. The NPV 8% pre-tax is up 21% to $344 million. And post-tax and royalties, the NPV is up to $188 million with an IRR of 18.4%. Capital cost is up about $35 million, which is 14% to $279 million, which includes the contingency, and the payback period is down about 5 months to 4.5 years from mill startup. On slide 10, the highlights of the capital costs are there. The total capital cost is $253 million plus contingency of $26 million, given a total of $279 million. And you can see the main components of the capital cost. The The main items been mine development of 37.7 million. I mentioned that with the increased mine production, that it does result in increased mine development that's necessary in pre-production. So mine development, probably almost the single largest capital cost item at 38 million. The site preparation, infrastructure, etc., 19.4 million. The mill plant at 31 million. That includes the DMS plant and the expansion, the new grinding circuit and the additional new flotation tanks. The paste tailings plant and process, that's a large item. It's coming in at 23 million, but it's an important item because it enables us to deposit all of the tailings back underground and the paste, and avoids the need for a surface tailings pond. Other site infrastructure is 16 million, and the all-season road up slightly at $68 million with owner's cost, EPCM, etc. at 33 million. So the total is 252 million, which is up a little bit from the pre-feasibility. But the principal reasons for the increase, I'm pleased to say, is not price escalation. It's actually mostly modifications. Mine development been a major part of it. The increased expansion on the mill, the early dewatering of the mine, and a number of other items which resulted in a slightly up increase on the road, which resulted in a slight increase in the capital cost, all of which we feel are fully justified. On slide 11, we've got the operating cost estimate per ton mined. It's expressed per ton mined. You can see the allocation there between the mining, processing, G&A, site services, given a subtotal on site of $153 per ton, and transportation on top of that is $68 per ton of ore mined. We're pretty comfortable with those operating costs. We think that they're good numbers, and they're down somewhat from the pre-feasibility study. The principal contributor to the lower operating cost, of course, is the increased mining rate, and the higher the mining rate on a per unit basis, the lower your costs are going to be. So on slide number 12, we sum it all up on the financial analysis and trying to show some sensitivities. Our base case, we used $1.10 per pound of zinc, $1 per pound of lead, and $19 per ounce of silver. These are long-term consensus price forecasts over the long term. As you well know, the price of zinc is substantially higher than 110 at the moment. That's the base case. It results in and that exchange rate is at 125 to the US dollar. That gives us an undiscounted pre-tax cash flow of 900 million and an NPV at 8% of 345 million, and IRR of 24%. Some people might suggest that on the feasibility study you could use a lower NPV, a lower discount rate at 5%. If you applied a 5% discount rate, you come with 497 million on a pre-tax basis. But we've used, as a base case, we've used the 8% discount rate. Post-tax, you see the numbers there. It's undiscounted is 562 million, NPV at 8% of 188 million, given an IRR of 18.4%. This is post-tax and post-royalties and post-Aboriginal participation. So there's government tax, there's government royalties, there's Aboriginal participation, and there's the Sandstorm 1.2% NSR included in the after-tax numbers. If you sensitize that, and there's of course any combination that you wanted to try on it, but we took the zinc price up to 120, leaving everything else the same, leaving the exchange rate the same, and that's still below today's zinc price. That increases the IRR pre-tax to 26% and the NPV 8% to $410 million. And down at the bottom of the chart on page 12, if you change the exchange rate to 137 to 1, which is really not out of line based on recent historical exchange rates, at the base case metal prices of 110, you get an NPV at 8% of 500 million and an IRR of 29.5%, again pre-tax. And if you use the slightly higher zinc price at 120, all other metal prices the same as the base case, and at the 137 exchange rate, you get a NPV pre-tax of 574 million and an IRR of almost 32%. After tax, that NPV comes to 332 million and an IRR of 25%. So you can see from this table, we hope you can see the sensitivities of the project to the metal prices and to exchange rates. So, to sum up on the results, we are, as I said earlier, we're very pleased with the results. We feel that the pre-feasibility confirms the strong project economics, and that the improvements from the 2016 PFS are very, very important, and that they indicate a very viable project. So from here, we are looking at moving to look at the financing. We are currently engaged in advanced discussions with several finance providers, and meanwhile, ongoing engineering and early project work activities are underway to facilitate a rapid startup. And subject to financing, the development and construction period is estimated at 2.5 years, which would see the mine start up production in mid-2020. So with that, I would stop and happy to entertain any questions if we have any questions on the line.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. As a reminder, should you have a question, please press the star followed by the 1 on your touch-tone phone. If you wish to decline from the polling process, please press star followed by 2. If you are using a speakerphone, please lift the handset before pressing any keys. One moment, please, for your first question. And your first question is from David Davidson from Paradigm Capital. David, please go ahead.
Yes, good morning, John. Dave Davidson here from Paradigm. I'm just wondering two things. Number one, on the road, it's been basically the approval, or at least it's been submitted as approval to go ahead. I'm just wondering the time frame of that and construction. And then secondly, I guess in this, obviously you're in discussion with financing. I'm just wondering how you see that working out as far as mix, obviously the Sandstorm, NSR, there's bank debt and equity. So maybe a couple of those things you could just expand upon for me. Thank you.
Okay, David, thank you. The road the road situation is that what we have on the all-season road is the Environmental Review Board has recommended approval of the project. That recommendation has been transmitted to the responsible minister, which is the Minister for Indigenous Affairs. Under the legislation, the minister has up to 5 months to respond to that submission. That minister is required to consult with other ministers, including the ministers of the Northwest Territories, the Minister of Environment, the Minister of Natural Resources, and any other minister that has a permanent role here. We can't predict how long it would take the minister to respond to the review board. We didn't see any particular issue in the environmental assessment report that we think should cause the minister any particular problems. We are hopeful that it would get a speedy and positive response. But the important thing from the construction point of view is that the all-season road itself is not actually required until we're in production. And it was always envisaged that the construction of the all-season road starts on a winter road, and the construction of the mine itself is initially commenced from the winter road. So we do have a permit to use the winter road, and we can start on the winter road. And in fact, the first 2 years of the construction period are assuming that you're using the winter road, and the all-season road is really only required to be in position for the outbound shipment of concentrates, which is 2020. So we would be very hopeful that by the time that it is required, that the land use permits will be in place. I should have said that after the minister responds to the review board, the project then goes back to the Mackenzie Valley Land and Water Board, which is the regulatory agency that issues the land use permit. Who knows how long that would be? We have seen them as fast as 60 to 90 days. We have seen them taking over 15 months. We would not expect a huge long delay at the Mackenzie Valley Land and Water Board, because they've already issued us the land use permit for the winter road. I should also say that we also have to get a land use permit from Parks Canada for the portion of the road that works through the park. So the process, to answer your question in a long about way, is that we've got a couple of years to get the land use permit for the all-season road in place, because we would start construction on the winter road. And we are hopeful that there was nothing that surprised us or shocked us in the environmental assessment report. Most of the recommended measures arose from proposals that we had made during the process, and we didn't see anything in there that surprised us. So we're hopeful that will go forward. I can't say it goes quickly, but it will go at the pace in the Northwest Territories, and we think it will come out okay. On the second part of your question on the financing side, well, we kind of tried to duck those questions on today's conference call, because it's a little premature. We're only taking this feasibility study now and taking it to the financing plan and the financing strategy. We have been working on this over the last 6 to 12 months, and it was important that we finish the feasibility study so we have accurate feasibility study numbers and to discuss with the financiers. We do anticipate, as you might expect, that it won't be a one-stop shop. We see there have been a number of legs to the table. We certainly see at the moment anyway, our plan would see a bank debt of something in the region of between 60 and 70% of the total capital cost. We also see then that the balance will be backfilled by a combination of other type of financing, whether that is a stream or whether it's a mezzanine type financing, and then backfill in behind that with perhaps some off-take financing, and finally some equity. So don't have a specific answer for you, but that is our current focus, and we'll be working forward with our financial advisor. We've hired HCF out of London specifically on the debt financing, and they have been working with us through the feasibility study, and specifically in developing a very robust model which can be used by financial institutions to stress test the project and do all the calculations. So that's next, and we'll hope to be able to report progress on that over the next 6 months.
That's great, John. Thank you very much, and good luck.
Thank you, Dave.
Thank you. Your next question is from Matthew O'Keefe from Echelon Wealth Partners. Matthew, please go ahead.
Thanks, operator. Good morning, and congratulations. You must be very pleased. It's been a long road, and that's a very fine-looking feasibility study. My question is really just around, again, some of the next steps. I'm curious where you are with respect to assembling a build team. If you're actively starting to bring in or look for a team to organize and push ahead with construction. And also, what kind of early works might if everything goes right on the financing side, what kind of early works would we be looking at in 2018, and when would that start?
Thanks, Matt. On the first part of the question, on the team, yes, absolutely. We plan to expand the current team We have always intended to do that at the appropriate time. We think that our current team is strong on exploration, on mine design, on environmental assessment and permitting. But obviously, we need to supplement the team with people with specifically, I would say, project construction experience and also with direct mine operating experience. One of the important points coming out of the work we did on the feasibility study was we engaged Ausenco as the engineer on the feasibility study on the construction and infrastructure side, and of course AMC on the mine side. But Ausenco specifically were engaged on the feasibility study with the objective or general intention that their contract with us would be converted into an EPCM or an EPC contract. So the work that they've been doing, while it is at this stage studies, is in fact, and their objective is that it's converted into actual work. And the work that they did on the feasibility study is all, if you like, preparatory for that. So Ausenco, we believe, have a lot of very relevant, appropriate experience on the construction side. They've just finished in the construction of the Atlantic Gold project down on the East Coast, and of course they've lots of worldwide experience and northern experience. So we think that on the construction side, that Ausenco will be a key to the construction project. But our intention is to recruit a experienced management on both the project construction and on the mine operations side. It was, it's a challenge to do that until you're able to give people a clear roadway to the project and to the financing. So I think now we have the feasibility study that potential candidates will be well able to assess the project, and we give some visibility on the financing. I'm sure that we will be able to recruit the key people, and that's certainly our intention to do so. On the second part of the question, I'm going to ask Alan Taylor to address the early works and the type of work that we might undertake in 2018. Alan, please.
Okay, thanks, John. Our intent is to move ahead with some early works on our path to production in 2018, which can be supported in a number of ways, either via winter road, which we have a permit for, or via air support. Those activities would involve both engineering design that we need to move ahead on, and that can take place both off-site and on-site, and our intent is to move ahead with that. Site preparations, including upgrading some of the shell structures in our main buildings, including the mill, the roof in particular, and the other buildings that need to be demolished or moved, that can be done, and preparation with regards to laying out some foundations for our new modules, which are mainly associated around the mill. And underground, we have rehabilitation to do underground, involving particular the preparation of the portal and the slash out of the new drive on the existing tunnel. That can be done on site in 2018. And in addition to that, we certainly can build up more road geotechnical studies that we need for the all-season road, and initialize the section of the road from out to the first site where we establish a camp about 30 kilometers outside of the site. Those are some of the activities that we can move ahead on in 2018. Of course, it's all somewhat funding driven too.
Great, thanks. And just one other question: is there what needs to happen for the MOUs with Korea Zinc and/or Boliden to be firmed up, maybe as an actual firm agreement?
The I think that goes hand in glove with the financing. The firm agreement requires an obligation on both sides, and that means there would be an obligation on Korea Zinc to take the concentrate and Boliden, but there will also be an obligation on the company to deliver. So as soon as we move forward and as we get a clear I'm going to say line of sight, but we'll get a clear timeline on the actual delivery of concentrate, then we can convert those MOUs into firm commitments. We have chosen not to do so because we can't take the obligation without being sure that we can deliver on that. So again, now that we've completed the feasibility study, we've got a timeline, and as the financing moves forward, you may assume that the financiers will want to see those MOUs converted into firm agreements. I should add that they're fairly detailed MOUs. They're not they're not just one pagers. There was a lot of time and effort put into them, and they're MOUs for the reason that I've mentioned, that we were not in a position to commit to deliver. So I think had we been said, okay, we want a firm agreement, they'd say, okay, well, what year are you, when are you starting delivery, and then we could have a firm agreement. So it will move forward in parallel with the financing.
Great, thanks very much, and congrats.
I should add to that, Matt. Sorry, that we, with the increased lead production, we have a substantial portion of the lead concentrate production still unspoken for, if you like, and available for offtake. And we certainly would. One of the things we want to examine is see whether or not there's what kind of financing or what opportunity there might be for financing against the uncommitted lead concentrate.
Okay, great. Thank you.
Thank you. And your next question is from Stefan Ioannou from Cormark Securities. Stefan, please go ahead.
Great. Thanks very much, guys. Good to see the study. Just curious, with under the new feasibility study, just in the capex, looking at the mill side of things, there's mention of sort of some new grinding and processing equipment in general. Just wondering, how much of that is just to sort of boost up the throughput a little bit versus are you actually sort of now deciding to sort of not utilize some of the older equipment that's already there and replace it with new stuff?
I think that, again, I'll refer that question to Alan Taylor. Alan?
Yeah, Stefan. Actually, we're trying to maximize the use of all our existing equipment as much as we can, and the pinch point in the mill production is on the grinding circuit. And with regards to the existing ball mill, we've done some metallurgical grinding studies and flotation that shows that we can put the 1,200 tons per day through the grinding circuit at somewhat of a coarser grind without reducing the recoveries. And in addition, utilize most of the existing flotation circuits to a point, which some of them need upgrading. Certainly the thickeners need higher rates installed. And but one of the key increases in capital costs associated with the mill is the paste plant. Paste is very expensive. The plant itself, and just to get the cement in for the binder is very expensive. But overall, the crushing circuit, if you go back at the start of the mill, the crushing circuit itself is more than capable of handling that rate. So this feasibility study is basically maximizing the mill's capacity.
Okay, great. Thanks very much, guys. That's helpful.
Thank you. At this time, there are no further questions. You may proceed.
Are there any other questions on the line? If anybody would like to ask a question, they could please indicate to the operator. Well, there's no more questions coming up, so it looks like hopefully we have answered all the questions. We hope that the information has been somewhat helpful in helping you understand the results of the feasibility study. As I mentioned at the beginning, these results in the press release are preliminary. We will be filing the technical report. Our plan is to file it during the month of October. although we have 45 days, which would take us a bit beyond that. We don't expect we're going to take the full 45 days, and we're not expecting any changes from the results as announced in the press release, but until the technical report is filed, these results are preliminary. So I'd like to conclude and thank everybody for listening, and thank those who asked the questions for participating. And as I said at the very beginning, we are very pleased with the results of the study. We think it demonstrates a very, very viable project and a good mine. We now need to get on and try to raise the financing to build it so that the shareholders can benefit from this long-awaited project. So thank you very much for listening and terminating the call.
Ladies and gentlemen, this concludes your conference call for today. We thank you for participating, and we ask that you please disconnect your lines.